Good morning. I'm Lisa Lindsley, the Director of Investor Engagement at Majority Action. Welcome to the webinar, How Investors Can Utilize Escalation Pathways to Mitigate Systemic Climate Risk. We'll pause for another 15 seconds to let everyone who's coming into the webinar finish joining. We appreciate you being with us today, and we're really excited about our panel. Welcome. On behalf of Majority Action, the Sunrise Project, Share Action, ACCR, Follow This, and Reclaim Finance. Welcome to the webinar on escalation pathways. We're really pleased to have you with us today. My name is Lisa Lindsley. I'm the Director of Investor Engagement at Majority Action. And Majority Action is a nonprofit. We're focused on empowering investors in U.S. large cap equities to mitigate systemic risks such as climate change and racial inequity through their proxy voting and the proxy voting of their asset managers. So along with Share Action, the Sunrise Project, ACCR, Follow This, and Reclaim Finance, we identified escalation pathways as an urgent need for investment stewardship. And we are hosting this webinar together. We'll just give everyone a few more seconds to finish joining. There are still people coming in, so we'll wait another 10 seconds. Great. So as I said, thank you for joining us. This webinar is being co-sponsored by Majority Action, the Sunrise Project, Share Action, ACCR, Follow This, and Reclaim Finance. And we identified escalation pathways as an urgent need for investment stewardship. And just a few facts to demonstrate this is that in the last Climate Action 100 Plus net zero benchmarking, 100% of US-based Climate Action 100 Plus focused companies in the electric utility sector were misaligned with the goal of net zero emissions from electricity generation by 2035. 100% of US-based Climate Action 100 Plus focused oil and gas companies were on pace to exceed the carbon budget of 2 degrees Celsius of global warming. And 100% of US-based climate critical banks continued to enable the expansion of fossil fuels despite their net zero commitments. And I'm sure many of you saw the PRI study released yesterday that concluded that only 23% of majority supported shareholder proposals were expected to be implemented by their proponents. So in the face of this, continuing to do the same thing in the face of this inaction would be irresponsible stewardship. Next slide, please. So this slide has a few housekeeping details about how to interact with this webinar. And while I'm introducing our speakers, before we start asking them questions, my colleagues are going to launch a couple of poll questions for the audience, so please participate. Next slide, please. Next slide, please. So Ellen Quigley is one of our panelists. She's the research associate in climate risk and sustainable finance at the Center for the Study of Existential Risk and the advisor to the chief financial officer at the University of Cambridge. Next slide, please. John Hupner is the head of U.S. Stewardship and Sustainable Investments at Legal and General Investment Management. Next slide, please. Tim Smith is the lead investment stewardship manager at Norges Bank Investment Management. Okay, we'll wait until the polls are done so you can see the rest of the slides. Great. The organization sponsoring this webinar agreed on a list of requirements for an escalation pathway. And what these have in common is that the issuer knows what's being asked of them. What they're expected to do is transparent and public, as are the consequences of the issuer not doing what their owners are requesting. I'll add that today's session focuses on climate risk, but an escalation pathway to mitigate any systemic risk, such as racial injustice, is a tool that shareholders should deploy. Next slide, please. Reclaim Finance, one of the sponsors of this webinar, has kindly provided this template that investors can use to structure their escalation pathway. And in terms of the options for type of action described on the Reclaim Finance template, here are some of the alternatives. Share Action has provided a sneak preview of early findings from their point of no returns research on 77 asset managers, finding that while the majority had some escalation steps, only over a third included triggers or time limits, and nearly half referenced some of the consequences that we had on the prior slide. One of the most important components of the escalation toolkit are votes against directors. And this Tuesday, Majority Action released Climate in the Boardroom, looking at the extent to which the largest 20 asset managers continued to rubber stamp the boards of climate critical companies. The largest 4 asset managers supported these climate laggard boards at rates similar to, and in the case of State Street greater than, they supported overall boards in the S&P 500. So clearly, if you are a client of BlackRock, Vanguard, Fidelity, or State Street, and you're concerned about climate risk, your relationship managers need to hear from you. In the good news section of the report, the asset managers holding directors accountable did so at a higher rate in 2022 than they did in 2021. One of those leading asset managers is LGIM, and we'll kick off our panel with John from LGIM. Here's an example of LGIM's escalation pathway. So John, the questions we'd like you to start with are, what constitutes your escalation pathway? How did you come to adopt it? And has your escalation pathway resulted in impaired engagement with issuers? Sure. Oh, okay. I think I'm being told John got disconnected. So John, the questions we'd like you to answer are, what constitutes your escalation pathway? How did you come to adopt it? And has your escalation pathway resulted in impaired engagement with issuers?
Excellent. Sorry to drop at the moment you asked the question. So let me ask those 3 questions. So first is, thank you so much for having me. LGIM adopted what we call our Climate Impact Pledge in 2016, which was, we called it engagement with consequences, initially targeting 80 global companies with 80 global companies with a structured engagement with 1 year and 3-year time-bound requests, where if we didn't see progress during the course of our engagement, we would vote against a director, the chair of the board, in most cases, and also divest in our sustainability-oriented funds. We have lots of different types of strategies across our organization, but the director vote was across all discretionary voting, and then the divestment in sustainability-branded funds. So the steps were direct engagement, disclosure, time bound, and then the trigger was whether or not they made that ask. In most cases, those specific asks were going to be measured by third-party indicators, so it was a really clear kind of third-party data point, often to do with disclosure. Sometimes it did have to do with actual strategy. For example, the targeted sunset of coal-fired power plants, etc. So that was in 2016. We expanded our strategy. So what did not only include direct engagements and actually used kind of quantitative models, and expanded that out to 1,000 companies starting in 2020. So last year we had our first vote across assets, and there ended up being 80 companies which we voted against a director on a global basis because they did not hit our minimum expectations of our minimum climate expectations. To answer your last question of has the director vote, or in general this idea of escalating our strategy impacted our ability to have meetings? No, quite the contrary, actually. In some cases, and we put in our public domain that when we actually took an action against ICBC in China, we took a voting consequence and actually a divestment consequence that actually helped us unlock conversations that had stalled. So we didn't feel that we haven't yet really felt that impact where a director vote has negatively impacted. I'll pause there. Thanks so much.
Great. Thank you so much, John. Now we're going to turn to Tim Smith from Norges Bank Investment Management. And Tim, the question we'd like you to kick off with is how does Norges Bank Investment Management think about the timeline of your escalation policy, given the global imperative to cut emissions in half in absolute terms by 2030?
Yeah, again, thanks very much for having me on and sort of tackling this important topic. Perhaps I can start with a little bit of context for the nature of our organisation, and that will explain some of the sort of slightly different approaches we may have as we move through the topics. So Norges Bank Investment Management is the asset manager for the Norwegian Government Pension Fund Global, which in turn is owned by the Norwegian population. At year-end 2022, that was around 12 trillion kroner, or $1.4 trillion, and that's invested across 9,000 companies in 60 companies. So just giving you an idea of the sort of scale to start with. The fund first started engagements with companies in regard to climate change in 2006, and since 2009 has been publishing what we call expectations documents, so our kind of public guidance for company boards on how to approach managing climate change within their organization. So I mentioned that the mandate for the fund comes from the Norwegian government. So in 2021, the Ministry of Finance formed an expert committee to look at how the fund could strengthen their performance and their structures in terms of climate change. And that resulted in a government report and an explicit change in mandate, resulting in a new climate action plan, the first one for Norges, released late last year. Now that climate action plan covers the period 2022 to 2025, and then we've also announced an external advisory board to provide scrutiny and guidance in the delivery of the plan. So that's just a bit of the sort of framing. Within the plan, we have some high-level objectives that will be familiar to sort of people in this sphere, so to help our portfolio companies reach net zero emissions by 2050, but we also have some additional tools and structures in the engagement process to help that take place. But the way I would characterize our approach is perhaps in a little bit of a contrast to the explicit time-bound approach, is that we're very principles-based, and we have a focus on transparency in how we approach things. And by transparency, I mean transparency of our expectations of companies, and also transparency in terms of how we actually perform relative to our own expectations. So to give you some examples of those, we started disclosing our votes ahead of company meetings. So we now give sort of 5 days of sort of pre-notice on voting intentions, and where we're voting against the companies, we'll also give a rationale for it. So that's one example of the transparency we're applying. To move on to the toolkit and how we apply it, as I said, we definitely have this principles-based approach because of the diversity of industry, region, company size that we deal with. And we have, beyond the traditional active engagement process, a couple of tools that I think are quite unique. So on the first hand, we have a structure called ethical exclusions. And these are determined by the Ministry of Finance. They follow either product-based based or behavioral exclusions. So those are ones that are mandated by the government, they're removed from our benchmark. And we also have a category called risk-based divestments, and those are more like a traditional research-driven divestment where it's removed from the strategy, but it doesn't come out of the benchmark. And so there is performance risk attached to this. And again, we disclose the performance outcomes from those divestments. So these are some of the additional tools we have in place. Just to give you an idea for these, we had sort of 12,000 shareholder meetings to participate in last year. We voted in 407 shareholder resolutions on sustainability and voted in 38% of those in favour of the resolutions. And in our climate plan, just a sort of final point to make, we've also talked about adding our own ability to file resolutions as a new tool in the Norges approach. So hopefully that gives you a good idea of how we're principles based in order to provide flexibility to the kind of breadth of the mandates, and obviously a function of being a universal owner, but have a lot of shared tools and then also some idiosyncratic tools in a Norges context. So I'll stop there, but happy to expand on those in questions later on.
Great. Our next question is to Ellen Quigley. Ellen, could you talk a little bit about how you compare engagement with issuers with other components of the escalation pathway, such as votes against directors?
Thanks, Lisa. Just to say, my approach to all of this is one around basically the deployment of academic research. So reviewing a ridiculous number of papers in this area and then trying to formulate a suite of tools that will be more likely to be effective than those that have been suggested in the research to be less effective in the longer term. And there's some disappointing stuff that comes out of that research, I suppose. And it's a bit surprising, and I think probably will be surprising to people on the call. I can personally point to examples in which what I'm about to say is not true, and some of the people on this call, the organizations on this call, are the exceptions, I think. But as a rule, shareholder resolutions haven't really gotten company level behavior change. You could point to kind of longer term shifts in social discourse. And again, there are examples from share action on banks, for example, where you can see shareholder resolutions have fed into concrete changes at the company level. But in general, and I'm just going to say this rather starkly, most of the engagement that's been done hasn't worked very well. Emissions are still going up. To much, I mean, they're supposed to be coming down, they're still going up. Lisa, you mentioned in your introduction, there just aren't companies that are genuinely aligning, especially those that are the top emitters. And the banking sector, which is the provider of the bulk of that primary market, new capital flowing into fossil fuel expansion, often isn't even on people's lists of engagement targets. So we've got a problem, and the evidence that we have in this area is kind of depressing. So that's how I kind of look at an escalation pathway, and I would kind of take some things out and really emphasize other things. So one thing that I would question is any emphasis on disclosure or transparency as the ultimate ask in an engagement, because if you look at, there's been a fairly recent meta-analysis of the link between environmental disclosure and environmental performance, and there's actually a weakly negative correlation, meaning that worse companies are more likely to disclose, but that's not actually changing the degree to which they are high emitters. So basically, disclosure itself is not going to get us where we need to go. It's, we don't totally need more information, but it would be more useful to think of it as a means for a much more ambitious ask. So you can, get the disclosure to prove that the company has done an actual action that you have asked them to do, as opposed to having the disclosure ask be the point of the engagement. And then I think it is worth emphasizing that director votes appear to be more likely to produce company level results, and they are becoming more common. But and I warned John that I was going to pick on him and Elgin, and he was very good natured about it before, so I'm going to go ahead. But when you've got an an asset manager like Elgin that's perceived to be one of the leaders who's only voting against 80 directors on the basis of climate when, again, the stats are as bad as they are. That's a huge problem. And especially when you see, again, Elgin not supporting efforts by other investors where we know that collective engagements are more likely to be effective. When we have flagged votes by other investors who've decided that even within the Climate Action 100 plus list of high emitters, there are some who are particularly bad, and an institution like Elgin doesn't back up fellow investors in voting against those directors. That's a real problem. So I guess I would just say there needs to be more of an emphasis on these tactics that have a greater chance of working. And also, I think we need to have a real willingness to combine tactics because, again, the limited evidence that we have now suggests that actually combining tactics is more likely to be effective. It's a bit like what John was talking about before. You can kind of put yourself in front of people more effectively sometimes by being a bit spikier. I think there is more of a worry that might be unfounded that sometimes if you threaten to divest or threaten to vote against the re-election of directors, that will somehow shut down the conversation. But actually, if you look at the evidence that we have to date, those threats actually are more effective at producing company level change. So like companies that are threatened with exclusion from a responsible investment index are more likely to comply with the engagement demands, stuff like that. So combining tactics is potentially more effective than any one of these things in isolation. And then I guess the other thing to say is that this is why it is important to pair this conversation with one about divestment. Engagement hasn't been that effective to date, and we need to do a lot more to increase its efficacy. But just to point to, divestment is also a legitimate pathway in that it is aimed at stigmatization of companies, and that is that's kind of a precondition to the legislation that we require. So it's a different kind of mode of a different avenue of influence that's, I think, equally important and needs to be considered. So if you are an institution and you have more fame than money, I think it probably makes more sense to go with divestment and make a big deal out of your announcement so that you can contribute to the stigmatization that's required to get legislation. If you have more money than fame, then probably better to deny primary market capital and vote against the re-election of directors and other kind of spiky engagement tactics. So it depends on what kind of institution you are, what kind of escalation pathway you should have.
Great. Thank you so much, Ellen. I'm going to give John a chance to respond, but before and then we're going to go back to Tim Smith on the initial question that we asked about cutting emissions in half by 2030. But before I go back to John, I just wanted to say that, yes, I think that the Majority Action and the organizing institutions of this webinar agree with you that the components of an escalation pathway are not mutually exclusive, and you can both vote against the director and file a shareholder proposal and have a call with the company and write a letter. And also that when we talk about transparency, we're talking about, and disclosure, we're talking about the transparency and disclosure of the process and of the consequences, right? For what actions the share owner will take and what demands are being made. We're not focusing on merely disclosure as opposed to climate performance by companies. So John, I'll turn it over to you.
Sure. I largely agree with what Ellen said. I think I put a few caveats. I jumped right into describing the tactical escalation strategy related to direct engagements and proxy voting. When you take a big step back and you think about how Elgin uses the broad toolkit available, it absolutely combines strategy. So I agree with Ellen that, and I think Tim mentioned this right away, you start with transparency of your own policies. You have direct engagements. We're part of every collaboration engagement you can think of. Whether or not we execute on a mutually agreed upon director vote, I disagree that that's the only mechanism. I think if you have your own escalation strategy that's voting against a chair, that would be a very legitimate strategy. And whether or not you want to join a collaborative engagement where you're an active member and choose different decisions, I think that's actually quite healthy rather than a negative. But anyways, we can argue about that. I also would point to openly changing our capital allocation. So we've taken a view, we've actually integrated climate risk into public ESG scores that we have created that tilt capital away from companies. And there are times when you divest. So we use all the policies, and I should mention, we're also engaging with regulators. So, I personally wrote to the FDA last week around methane disclosure and taking our position on that. So at a systematic level. So we filed a shareholder resolution a few months ago at Glencore. So we're using all the different pieces. We absolutely agree with Ellen that you want to think about, as an asset manager, where you are and how to be most strategic. But I will also point out, we're a UK headquartered asset manager with global clients. Their debate is very, very different on different continents. And so we have to make sure to think about that, right? I actually think one of the best influences that I can have is pull many of my asset management peers along. So when I look back at my climate impact pledge in 2016 and the escalation strategy that you looked at, it actually has been emulated by many of our largest peers. So there's going to be influence in different ways. So I'll cut short there. Thanks.
Great, thanks, John. And Tim, we're going to go back to you about the mandate to cut emissions in half in absolute terms by 2030. And if you could talk a little bit about how your principles-based system contemplates that.
So I think it's about understanding where the company is in the kind of life cycle of its own approach to tackling climate risk and its own target setting. So I think that the reason why we look at it on the principles basis, we want to be able to focus on target setting and sort of disclosures as kind of foundational pieces in certain companies, and then pivot to transition planning to take a kind of topical subject to the moment in those that are the kind of quickest adherence. And so what I mean by that is without having the kind of the particular timetable attached to different pieces, we can pivot to the most appropriate bit on different companies. And similarly to as John said, we deal with a global portfolio where the appropriateness of an ask with a company in a certain country or of a size in a different industry it is more or less appropriate depending on those characteristics. So I just don't think in your conversations with a company, if you go in with a one-size-fits-all set of asks that says, please disclose in this format, please plan in this format, you're ignoring local legislation and disclosure requirements. You're ignoring local subsidy regimes. You're ignoring the local shareholder base. So I just think you have to be very sympathetic to where the company operates and what stage they're at. Otherwise, you do just sound like you're listing a kind of menu of default asks without really understanding their business model, and that's really important, because that's when it becomes like a lecture, and we want to avoid sounding like we are projecting values in a lecturing sense. We're trying to have rational conversations about kind of adherence to our expectations, but not in a way that says you should do this at this point because we say so. There has to be more to it in the conversation.
Just from the discussions we've had with shareholders, it seems like you don't want to micromanage a company by telling them how they achieve the climate performance target. But since climate performance targets have been established by international credible agencies like the IPCC and the IEA, it's rational and good stewardship and consistent with fiduciary duty to draw those bright lines for them and then let them decide how they're going to achieve them. I don't know if John or Ellen, you want to make any comments about that?
John, do you want to go first, or
Yeah.
Tim, did you want to respond?
I can just add one thing on there. I think I'll give you an example of this balance between principles based and prescription that we're trying to strike. So obviously in our in our climate action plan, we talk about companies having science-based pathways, and that's obviously the slightly almost like a sort of cliche in our industry about the big S, little s. So we accept that at the point in time of writing, there are certain sectors that haven't had a pathway under the Science-Based Targets Initiative. So there should be an ability to accept something that is a science-based pathway in a non-organizational branded sense. And this again is something that applies to industries and to different countries. So that would be an example where by having a science-based pathway, you are implicitly having something that is based on the pathways we're talking about. But if I was to make it too prescriptive and say you must have a big S science-based target under XYZ regime, lots of companies will say, well, it's a little bit more complicated than that, and we don't have this. So that would be a good example for me of where you can implicitly ask for the emissions pathway that is associated with 1.5 degrees, but you don't necessarily have to have a branded endorsement of it, if that makes sense.
John?
Yeah, I think I agree with that characterization. And I think, it's hard for us at a sector by sector level to have really clear pathways, decarbonization pathways. And so you try to use the latest research that's coming out, right? And so we do change, right? So, and things are shifting. So I think for us, I guess my message is that we know our own limitations, and so we're very willing to use third-party endorsements, right? So when we, third-party kind of pathways or research, that's why we're often referencing back. We're going to be supporting shareholder resolutions calling for, alignment to the IEA's scenarios of when things have to kind of phase out. I think it was well said by Tim, but nothing much more to add.
Great, thank you. Ellen, do you have anything to add there?
Yeah, just to say, I think there is. I'm very sympathetic to what you've both said, and there are so many particularities of different jurisdictions and so on and so forth, and that definitely complicates the discussion. One thing to just mention is that, when we started engaging with our banks at the university, and it's now a massive collaborative engagement that's starting to include other institutions. And basically, that's a sort of second order engagement exercise, because we're trying to get the banks to basically do some engagement and denial of primary market capital within the market. And what we saw was a lot of loopholes and evasions in the targets and the methodologies that they used. And that's a problem at the company level. That's a problem at the bank level. It's pretty pervasive. I'm actually building some bingo cards for the most common loopholes and evasions that we find in this process. And I guess one of the things that finally occurred to us is that we needed to look at things that didn't rely on the specificity of the scope 3 disclosure or the detail behind some of these pathways. What we look at is some of the most high impact long-term sources of carbon lock-in. So basically the construction of new fossil fuel infrastructure that would lock in decades of demand for fossil fuels, emissions, and of course, dependence on some regimes that we might find unsavory, like Russia. And that's potentially, you can tell from space if somebody's building a new coal or gas plant. And by the way, those two are the top contributors to fossil fuel lock-in in the long term. And so we basically found that by focusing quite narrowly on some of those things that that are not as gameable and that are particularly high impact and long term, that has allowed us to have conversations that have a level of detail where it's still useful, but not getting into some of these tough jurisdictional, very specific conversations that I agree are quite complicated.
Great, thanks, Ellen. I wanted to ask Tim and John, and Ellen, you may also want to respond, how your escalation pathway is consistent with fulfilling your fiduciary duty to your beneficiaries or clients. And John, can we start with you?
Sure. And so is the question kind of, do we think about it differently by jurisdiction? Is that kind of underpinning your question? Or
No. No, I mean,
So
I
yeah,
think you think about it overall, is my
yeah,
understanding.
I just want to make sure, because so our view is that climate risk can impact, well, will impact our, portfolio value of all of our clients. So we have to mitigate. And so I don't really know where your question in terms of how is it aligned to our fiduciary duty, or where are you going with that? I want to make sure I understand.
Yeah, so many times we speak with main, big asset managers who say, "Oh, I'd love to do this or that, but that would be inconsistent with fiduciary duty." And it is still kind of mind-boggling to get that answer, and given what's going on in the world, but we do, and so just trying to understand and lay out the arguments for how this is consistent, because it seems like common sense, but obviously it's not to everyone.
Yeah, I think that for us, we definitely take a bit of that long-term perspective, and try to look at it kind of a more universal and holistic way. I will tell you the hardest conversations we have. We recently had an engagement with a company that said the next incremental dollar that we invest towards our decarbonization will hurt our TSR. Do you want us to take this? And so they were really testing the philosophy of how committed are you, and of course, we push back on, do they really understand their long-term costs and what projects, and that ends up being a tough conversation, but that is where the conversation is headed, that we see, but you have to look at this much more, for sure, in a long-term perspective, and really test, are the companies looking at their total cost.
Great. And Tim, I know you mentioned a little bit about the analysis of companies you divested, and including that as a comparison, but also there are other components, obviously, to the escalation pathway. So could you talk a little bit about how this is part of your view of as a universal owner and fulfilling your fiduciary duty?
Yeah, absolutely. And we have, as I said at the start, a unique structure in that the mandate comes from the Norwegian Ministry of Finance. But that's actually extremely empowering for our structure, because the government has already decided that climate risk is material. We don't need to have the conversation that most of us on this group will probably think the same thing, but that's not part of our discussion process. So the Ministry of Finance has decided that the fund will be maximised by delivery of an orderly transition towards a mid-century net zero. So there's a really strong and unequivocal mandate that links our approach to delivery of the single client's objective. So there's a slightly different structure. But what it does also mean is that we have the ability to change the asset management level approach to it. And so, Ellen was talking about sort of providing capital in sort of primary markets and sort of the different roles in secondary markets. We have the ability to express some of that through asset allocation at an early stage. So in 2021, the fund started its first direct investments in renewable infrastructure. So that's one where we can obviously explicitly, albeit from a small base, explicitly allocate capital to projects that are kind of not captured within corporate boundaries. So that's also a slightly different feature of our mandate that is beneficial here.
Great. Ellen?
I love this question, and also that everyone's talking about universal ownership. So I'll just lean into that for a moment. And just to say, this is why I think there are legitimate critiques of the usual ESG approach, which involves a lot of stock picking in public equity, where it's unlikely to have an impact unless you're a famous institution that can do the whole divestment thing. You can't avoid climate risk to your portfolio unless you're helping to mitigate climate change in the real world. There's statistics suggesting that 50% of GDP rests on biodiversity, right? So there's no fancy portfolio you could construct that will be immune from the effects of climate change and biodiversity loss and this kind of interconnected ecological crisis that we find ourselves in. And that has now started to be recognized by Freshfields, for example, their big report that came out at the end of 2021. I highly recommend that people read it, or maybe not it, because it's well over 500 pages, but maybe the shareholder commons 5-page summary of it, which clarifies that across the big 11 jurisdictions in which many of the companies with the highest emissions are domiciled, the investors have not only are they allowed to look at these impacts, the impacts that their portfolios are having, but they're arguably obligated to manage impacts, not just risk to portfolios, which again just doesn't seem adequate given the level of the externalities that we're talking about now. So I actually think that an approach that is more impact oriented across the whole portfolio is actually more compatible with fiduciary duty than a traditional ESG approach. Also because if you're not doing as much stock picking on the public equity side, you're going to get less variation in returns in that part of the portfolio, meaning you're more likely to actually, in the short term too, perform more in line with the market and not take a hit financially or risk that. So I think actually fiduciary duty is very much in line with this, and that's starting to be recognized by senior legal experts who have done all the work to compare across jurisdictions.
Great, thanks, Ellen. So the next question is on behalf of institutions that are thinking about implementing escalation pathways. What are your thoughts about how to map on your previous engagement efforts to your new escalation pathway, as opposed to like going and starting over? So say you've been filing shareholder resolutions and having engagement calls and maybe doing sign-on letters. How do you phase in an escalation pathway? And John, I think it's probably best if we start with you, since Elgin has had this in place since 2016.
Yeah, I guess my imperfect, I mean, I'm not an investment consultant, so I don't know I have to think hard about this. I think it really comes down to resources, frankly, your own internal resources to manage escalation campaigns, or if you can push it off to, a third party or your investment, your asset manager somehow. It is just time consuming. So I don't know. I guess I go back to kind of something that Ellen said, like, I don't think this is all linear necessarily. You can kind of do all of this at once, but you got to use, your particular point of leverage the most. If you're an asset owner, your number one largest leverage is leaving your asset manager. That's your largest leverage, because your asset manager probably has multiples of, unless you're a huge asset owner, that is your point of leverage, or your investment consultant. That is your point of leverage, but no one does it. So, I don't think I think you just have to find your point of leverage, but you can build your pathway from there.
Well, as you know, that's music to the ears of the team at Majority Action and our partners on this webinar, who do a lot of work to put out research reports showing how asset managers are voting in contrary to the best interest of their clients. Ellen, did you have something to say here?
Yeah, just to say, I've actually been using Majority Action's reports just recently. In fact, one of the emails went to Elgin to point to where there could be more action on particularly director votes, since that's what the evidence suggests is going to be more useful. I just couldn't agree more in terms of the leverage over asset managers. But I would also say that that banks are the other big piece, even as a client, not necessarily even as a shareholder. That's what we've decided at the university those are our two main targets. And then what we do when we engage with an asset manager is to have them focused across their entire portfolio, not just the particular fund that we happen to be invested in. We want to change their overall behavior. And what we've also just found, by the way, is that you have to ask a fairly small number of questions to get actual action on any of them, to just say, this is what we'll be watching for. this year very specifically, that's what's generated results. But actually, I do agree, losing mandates is a huge motivator for asset managers. And we're actually starting to do that at Cambridge as well.
Great. Tim, did you have anything you wanted to add on this question?
Yeah, I was going to say, in terms of starting from the beginning with a new process, and I think the marketplace does have a collective muscle memory, and so the idea that you would allow a company to kind of start from stage one for procedural reasons doesn't really work with me. And I think I think of the kind of the change process as being non-linear, because companies tend to move in step changes. They announce plans, they change strategies, they adopt certain asks, whether by kind of voluntary means or through sort of external pressures. And so I think you often have this situation where companies see their peer group move and then they play catch up, and then you have leaders at the front. So I think you have to be aware of what a peer group is doing, and clearly you can be a laggard at a market level, but you can also be a laggard for a US company in a particular sector. So to me, if you're studying a new process, you should be cognizant of what's come before. And having said earlier that we don't have any kind of written in kind of time bindings into the plan, I think intuitively most of us would agree that if you're doing something in a slightly different way with a company for a second and third occasion, then the timescales obviously have to contract. So I don't think for a moment that the clock overall resets just because you slightly change the structure of the process.
Thank you. That was a great way of summarizing it. Ellen, did you want to add something?
Yeah, sorry, Tim just reminded me that I didn't actually properly answer your question, which is, when we bother fund managers about their voting behavior using majority actions reports, we kind of they all claim to be doing engagements with companies already. So if they're not ready to vote against any of the directors, then that kind of tells us something about the state of their engagements anyway. You have to be ready to vote against some of your directors if you've been doing a reasonable job of engagement for a while. Some of them have to be at the stage at which a director vote is warranted on the basis of the existing engagement. So yeah, if that's useful for asset owners, we find that it's a good indicator in a way of the rest of their engagement program.
Great. That's a great flag. So we're going to take one of our audience questions from Bo O'Sullivan. And this is, how should investors escalate engagement with companies like BP and reportedly Shell, who are now rolling back climate commitments in their transition? And in general, what are your red lines for fossil fuel companies that may lead to voting sanctions or other sanctions in 2023? Which one of you would like to take that first? Tim?
I'm happy to volunteer for this one because I suspect we will both be asked to comment on this one. So rather than comment on the two companies in particular, let me talk about approach for obvious reasons. So I think the starting point is we only have one major red line around fossil fuels. That's a thermal coal exclusion that I believe came in 2016. So that's just the kind of one piece of context there. In terms of what individual companies are doing and the perception of rollback, first of all, I'd say no one in this forum would feel the need to be talking about what the kind of marginal tool is if everything was going perfectly. So I would say, just as a starting observation, is that the fact that shareholders are developing tools that perhaps didn't exist in the past is a function of needing to be able to deploy them. And so, perhaps you can look at the leading edge as being some of the litigation that takes place. I mean, just to be clear, outside of our organization, but that would be an example of something that is a new vehicle that wouldn't have taken place in the past. So I think, generally speaking, we would say, the requirement for tools is not just an intellectual thing. It's a requirement for new tools under the expectation of needing to use them in the future. So that will give you an idea of the kind of necessity. And what I would say about one thing we highlighted in particular in the Climate Action Plan is voting against directors on transition plans, because for me, it's a really interesting pinch point at the moment, because kind of target setting is something of a freebie for companies, and we can talk about the kind of the sort of procedural process. We can talk about the financial cost, the time commitment, but essentially, any of us can make up any targets around our personal lives or our professional lives at any point in time. So I think we have to understand that the marketplace now, given where penetration rates have got to in target setting, is very quickly focusing on to target delivery. And as I said, there are some really good processes going on, including the UK transition plan task force, around what information investors need to be able to evaluate likelihood of planned delivery, but then also some perhaps more subtle ones that are focusing on lobbying. And so are there companies where there is a kind of superficially ambitious target, but the lobbying activity doesn't match the ambition of those targets? So I think the marketplace is switching onto these scrutiny of ability and willingness to deliver, and so that's why in the in our climate action plan we explicitly highlighted substandard transition plans as an area where we would be focusing and looking to scrutinize the most, because at the moment that's where we feel investors should be spending most of their time, because I think the main structures around target setting and reporting and disclosure are largely established.
And I can build a bit on what Tim mentioned. And I can put it in the chat as well. I mentioned Elgin has a climate impact pledge approach where we have 20 specific subsectors broken out, and we have sector guides of our expectations. Inside of those sector guides, we have red lines, so minimum standards by sector. So specifically for oil and gas, it is what Tim mentioned, these early days of disclosure. Our red lines is, has the company committed to a net zero operational emissions? Has the company made time-bound methane reduction and flaring targets? And does the company disclose its lobbying aligned to a 1.5 degree? So absolutely in that early stage, because red lines are really trying to capture on a global basis the laggards, and then that's where the systematic vote will start to occur. The question's different though for BP and Shell. They aren't global laggards, and so the only comment I can make there is we're in direct communications, right? This is a really pivotal moment in the market where perceived leaders are shifting strategy. So it's, for us, that means, get on the phone, direct engagement, try to really understand what's happening. So I can't comment beyond that, that we're in kind of direct dialogue. But I do think that there's a huge difference between red lines for us as a kind of universal owner moving the whole market, and how those red lines change year after year as we kind of ratchet up expectations and try to move laggards is really what a red line is for us. Less so when more leaders start to kind of pull back on ambition.
I would just add a couple of things. One is, I don't think that there is a justification for feeding primary market capital to any of these companies, because they're so far off the mark. So that seems like kind of a baseline. And certainly I would say pulling back on climate commitments at this point, I would say warrants voting against directors. So this is just kind of in line with what we've already been talking about. But I would just add another thing, which is that there's a really interesting analysis by Carbon Tracker that I think investors could be using with their peers. It talks about at what level the long-term oil price would have to be to justify continued exploration for reserves that on average are quite a bit more expensive than the earlier cheaper stuff that we've already dug up. And actually the analysis is a bit surprising for the investors in these companies. It's arguably better for them to halt exploration if the expectation is that the price of oil will be $50 or lower as an average over the very long term, which seems like not a crazy assumption. And again, if you're a universal owner, you want the outcome that we don't end up with fossil fuel expansion that's incompatible with any reasonable climate scenario anyway. So you've got actually a bit of a reassurance here for investors, purely from a short-term financial perspective, as well as the kind of long-term portfolio protection thing. So I just highly recommend, John, if you're having these conversations with peer institutions using that research. It actually came out of a question that our CFO asked Carbon Tracker a couple of years ago, and then they went away and did this wonderful analysis. So yeah, that just seems useful.
Great, thank you. The next question comes from Kira Belpasht. How does the panel think about the impact of pre-declaring votes as a mean to amplify one's stewardship signal? Do LGIM and Norges Bank pre-declare several weeks in advance of an AGM?
Yeah. You want to go, Tim?
Yeah, I'm happy to get them off. Yeah, we share our votes 5 days in advance. We think that's a really powerful public domain message. So that's definitely something that's a genuine part of the toolkit. We also are very transparent about the voting records, so you can see all of those on the website and a rationale for certain specific votes. So yeah, I think transparency on the direction and the reason for it is extremely important, and with that kind of benefit of time in advance.
And we don't pre-declare all of them. We pre-declare a few dozen each year, and try to put some analysis behind why we're pre-declaring. Again, probably send a signal to the broader market, but we view that as part of our strategy as well.
Great. I would just say that we are able to harness energy around pre-declarations if they happen within 1 or 2 weeks of the proxy being filed. So to influence both the proxy advisors as well as other large shareholders. When it's 5 days before the AGM, it's way better than not pre-declaring, but not quite as helpful as we would love. So we are going to move to start closing the panel, and my colleagues are going to launch a couple more polls. And we also want to share with you some of the reports that both Majority Action and Reclaim Finance and Share Action have published recently, as recent as this week, for 2 of them at least. And we will be, as we said at the beginning, we will be circulating the slides and a webinar of this recording. And I think that we have one more poll question. Is that right? Before we close. And we'll also be sharing the link to Norges Bank's proxy voting record so that everyone can see it. Okay, and Ellen is just dropping something here. So if one of my colleagues could please share Ellen's link to the Carbon Tracker report, that would be great. Great, thank you. I think that I want to really thank our panelists and thank our co-sponsors, ACCR, Follow This, Reclaim Finance, and the Sunrise Project. And I want to thank all of our attendees for being with us today. And for those who were unable to attend live, we will be circulating both the slides as well as a recording of this webinar. So we'll wait one moment to also post the link to the voting records of LGIM in the chat. Great. And on that note, once again, thank you to our 3 panelists and to our co-sponsoring organizations and to our audience. Thank you so much for participating today. And this ends the webinar.